Our latest trade on Palantir returned over 100% profit, and now the same wealthy investor we've been tracking, the one that led us to this winning trade, just placed another trade worth $27 million. So if you're not in our membership and missed our recent Palantir trade, don't worry, because there might be another opportunity setting up right now, especially with earnings coming up on November 3rd. So to reduce our exposure to this earnings risk, we updated our trade using the same strategy from this wealthy investor to manage risk and protect gains, a smart risk management approach that makes the trade basically risk-free, setting us up for more potential profits with no additional capital at risk. This risk-free strategy allows us to gain additional profits if the stock moves higher, while taking no loss if it drops lower after earnings. But here's the thing, to set this strategy up successfully, it's important to position early, just like the wealthy investor we've been tracking. On this day, September 8th, as the stock pulled back from its previous high, we detected unusual option activity on Palantir, giving us a bullish signal that the stock would most likely move back up higher, which it did. So we got in early along with our members and rode this big move all the way up to a new high, gaining about 30%. But our profits were even higher than this because we bought call options instead of just buying the stock. As you can see here, this was the email we sent to members alerting them of unusual option activity detected on September 8th. And so we analyzed those unusual options being traded in Palantir stock, ticker symbol PLTR, and went long bullish when the stock was trading around $157 per share. And now it's trading around $200 per share. So even if you traded the stock instead of options, it's already highly profitable because we simply got in at the right time. That's how the rich keep getting richer. They somehow know when to get in at the right time in the right stocks. And it shows exactly why we keep tracking their trades. So if you want to start getting access to the deeper insights that lead to profitable trades, including these email alerts, consider joining the membership on our website. We'll link it up here. Keep in mind that if you join the membership through YouTube instead of through our website, we cannot email you these additional trade alerts because YouTube does not share your email address with us. So if you want more opportunities to profit, make sure to join the membership through our website, where you'll get full access to the trades of wealthy investors and potential insiders so you can see what the smart money is doing before the trade becomes highly profitable. Now, speaking of profitable trades, how much did this trade actually make? Because knowing the exact profit is what allowed us to use a smart risk management strategy and set up our next trade based on the new data showing $27 million in unusual option activity. So let's take a closer look at our trade, the same one made by this wealthy investor. These November 21 options at the 160 strike calls. At the time, this investor bought 12,400 contracts at a price of $15.65 each. Keep in mind that since options prices are shown here and each option contract controls 100 shares of stock, to get the actual dollar value, we multiply by 100 or simply move the decimal 2 places to the right. That means each options contract costs $1,565. So how much are they worth now? Well, let's check the option chain for these November 21 options at the 160 strike calls. And we can see here, these contracts are now worth between a bid-ask price of $4,260 to $4,320 compared to just $1,565 when we first detected and bought these contracts. That's why it turned into such a profitable trade now. So how much return on investment did this deliver? Well, let's take a look at our analysis using the risk profile graph focusing on these November 21 options at the 160 strike calls, which were priced at $1,565 per contract when we entered this trade. And so on this graph, our profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Keep in mind, this graph already includes the cost of the trade. That's why you can see in the blue line that if the stock had dropped down, it would have been a negative $1,565 loss per contract, the entire cost of the trade when we entered. But instead, it went up higher to about here. So we have a profit of $2,726 per contract. And so to calculate the profit percentage, we take the profit of $2,726 and divide it by the initial cost of $1,565 and then multiply by 100 to express it as a percentage, and that gives us a return of 174% profit. And so this is yet another real-time example of how we keep winning using data-driven analysis and trading strategies that track the trades of wealthy investors. Because understanding where smart money flows gives us deep insights into potential stock moves in the market. The rich often have more access to exclusive research and information, sometimes even leaked insider information, that help them make better, smarter financial decisions. This is how smart money always stays one step ahead, well before the rest of the market catches on. No wonder the rich get richer. And so, if you want to get access to more of these insights from the rich, then just head over to our website. We'll put a link up here, where you can see exactly which stocks wealthy investors are trading on Wall Street, and when they're doing it, so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that being said, not all trades by the rich are winners. Some end up as losses. That's why we do not follow just any wealthy investor. We track the smart ones who are highly strategic. Because based on the latest data, this wealthy investor was not just making a new trade. They used a risk management option strategy that we often use ourselves to minimize losses while maximizing profits. So let's go over how we use the new data to adjust our trade here into a strategy that gives us more upside potential while managing risk to reduce losses. And so, as we can see here on the options time and sales tape, there was unusual option activity on October 31st at 3:19 p.m. at the 56-second mark in these November 21 options at the 200 strike calls and the 160 strike calls. But remember, these November 21 options at the 160 strike calls are the same options from our original trade. So what's going on here? Well, based on our deep analysis, this wealthy investor was closing their previous trade at the 160 strike calls to lock in profits and then rode into a new trade at a higher strike price. This means that these November 21 options at the 200 strike calls is the new opening trade. So we can calculate the total cost of this new trade by multiplying the price per contract by the number of contracts traded. First, we convert the option price of $14.65 into actual dollars by multiplying by 100 or simply moving the decimal 2 places to the right. So that's $1,465 per contract. Next, we multiply the number of contracts traded, 18,907, and this equals a total trade cost of approximately $27 million for this new trade. But keep in mind, just because a trade is large does not necessarily mean it has a high probability of success. In fact, this one carries more risk than the smaller, more selective trades we share on our website. And so, if you want to get access to those lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. Now, with that said, even though this trade carries higher risk, we still took it, but only because we locked in profits from our original trade, just like how this smart wealthy investor did by using an options rolling strategy to reduce exposure and manage risk. So let's go over exactly how we did this. As we can see here on the option chain, our original trade along with this wealthy investor was for these November 21 options at the 160 strike calls. And as we mentioned earlier, this investor closed their existing position here and rolled to a higher strike price. So we also closed our 160 strike calls by selling them, locking in profits. And then, just like what this investor did, we rolled these options into a new trade at a higher strike price to the 200 strike calls, where you can see our new position here marked as POS with the green color indicating a buy position. And notice how there's about 15,000 contracts opened here, which is less than the 18,000 contracts just traded. This shows that this wealthy investor opened new positions here, not closed them, because it would not be possible to close out 18,000 contracts if only 15,000 contracts were opened previously. This data is very important to confirm, because if a wealthy investor is closing out contracts or trades, it could mean it's not the right time for us to jump in since they're getting out of the trade. On the other hand, if a wealthy investor is opening new contracts, it could signal an opportunity for us to start a new trade. This is why we always take the extra steps to verify the data at a deeper level. Many other websites and scanners simply flag every high volume options trade as unusual without filtering out closing trades. That's what leads to false signals, wrong conclusions, and unnecessary losses for anyone following unusual option activity. But our deeper analysis filters out those false positives, which is why we consistently find more accurate and profitable trades than other websites. And in this case, our deeper analysis confirmed that this wealthy investor was closing contracts at the 160 strike calls and opening new contracts at the 200 strike calls. So that's why we used our profits from the same closing trade to buy these 200 strike calls. In other words, we opened a new trade that cost less than the amount we sold our original trade for at the 160 strike calls. That means we entered this new trade at a credit, not a debit, reducing our risk by using only the gains from our earlier trade. And so when we analyze our trade now, we can see here on the risk profile graph, the buy position cancels out the sell position because they are the same November 21 options at the 160 strike calls. So we are just left with the 200 strike calls that expire November 21. And so on the graph, we can see here that if Palantir stock drops from where it is now or even crashes, our trade would not have any negative loss. It will always stay positive because we've locked in more profits than the cost of our new trade. This is how we manage risk, by minimizing losses, and in this case, we completely eliminated any possible loss while still staying in the trade to gain more profits if the stock moves higher. But keep in mind, this risk-free strategy was only possible because we followed this smart wealthy investor early, back on this day, before the stock surged to a new high, giving us 174% profit, and now we're holding a risk-free trade going into earnings. So if you want to get access to our strategies backed by our deep analysis and trade alerts, just like this one, where a well-informed investor entered this options trade early before the stock took off, then sign up on our website. We'll link it here. Because the next time a wealthy investor makes an unusual trade, you'll want to be in early, not chasing after it's already gone up. As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.